you the application of law of one price in pricing financial derivatives and more. You can do a lot more with it. And and the approach I'm going to look at is called a perfect tracking portfolio, perfect tracking approach. And before I start this, I'll tell you a story to motivate the discussions here. So I think a couple of years ago, this is I stopped by a local State Farm agency, and the owner is Rob Taylor. You probably know him, some of you. And he's entrepreneurial. He owns a branch of State Farm agency, insurance agency. And at that time, he was trying to sell me whole life insurance. He said, why don't you buy whole life insurance? And so the whole life insurance works something like this. Okay, if I got a pen, okay, I got my Surface pen here. So does any one of you know anything about whole life insurance?
I don't.
So you didn't buy it, okay? It's useful. A lot of my restaurant friends, they bought a whole life insurance. Okay, so whole life insurance is working something like this. So suppose each year, so it could be monthly, okay? So each year, suppose I put in $12,000, okay, $12,000. So contribution, okay. To this whole life insurance. Whole life, okay, insurance. For a number of years, for N years, okay. So this is the investment, okay. And then the scenario would be, let's call it end result, okay. Okay, so this result would be scenario 1. If somehow you are so death, okay, so a death, suppose, okay. So because it's called life insurance, right? Life is between life and die, right? So death, if you die, it give you, let's say, $1 million payout. Okay. Second scenario is, the probability of you dying, is low. It's more likely you retire. Okay. Okay. In that case, so it guarantees you a, let's say, 4% return. Okay. So basically, this annual contribution will be returned to you, and on top of that, you earn 4% return. And recently there has been innovations. So it could be an indexed return to the market capped at a certain rate. So for example, capped at 7%. And if the stock market return 20%, you earn 7%. However, if the stock market lose 20%, you don't lose anything. Yours is zero. Okay, you don't have a loss. So they have those kind of insurance policies. So the gamble is, on some years the insurance companies to make money, and some years the insurance company has to compensate you. So that extra, of course, they have algorithms to calculate that. Okay. So that's a basic idea of whole life insurance. So my question is, with our financial engineering knowledge, with these derivatives, can we build a portfolio that may replicate these returns or do better? Okay, so I would propose something like this. Okay, so I would propose something like this. I'll use a different color. I'll use a blue color, for example. Okay, so this is a whole life insurance, right? Whole life. Okay, I'll build a portfolio. Okay, I'll have one investments. Okay, I'll have I'll spend about let's say for myself. Okay, this is from my own perspective. Okay, I'll get a quote for $1 million term life insurance. Okay, let's say $600 a year for 1 million term life. Okay, so if I die, I'll get a payout of $1 million. So that take care of this, right? Okay, and portfolio B, the investment B, I'll put in 11,400 a year to SP 500. You could use like a SPY, that spider index fund, for a number of years. And historically, the return of SP 500 is maybe 7, 8, 9, 10%. So let's say 8% average over a long time, like 20 years. Okay, it could be lower, 6%, but even 6% you are better, right? See, I replicated this one. So A plus B gave this whole life insurance. So it is replicating the cash flows or payouts. So which option would you choose? Would you rather buy whole life insurance, or would you choose the blue option, like build a portfolio yourself? So which is better in your opinion?
Portfolio.
Right, so that portfolio is probably will work better. But of course, rarely, if the stock market return, just in the next 20 years average 4% or below, the chance is low, but there is a chance there. If you fear about that, you could buy annuities. So there are annuities that you get a certain percent of return. Okay, or you could buy bank CDs, and nowadays bank CD is probably not very high, and that was a few years ago. But now the guaranteed return probably 3%. If it's 3%, you are even worse, right? So that's the idea of tracking portfolio, okay, replicating portfolio. So when you hear about something, you should think about from a financial perspective, can you build something yourself to track the payouts, the cash flows? And in today's lecture, I'm going to go over a few examples with you. Don't have many slides, maybe 20 some slides, and I think I'll probably take about an hour. Okay, and feel free to ask questions. So law of one price. Basically, if two assets giving same payouts, same cash flows, then they should be priced similarly. Okay, that's a law of one price. So here, consider two securities, A and B. Suppose a third security has the same cash flows as A and B combined. Then we will say security C is tracking portfolio B and C, or is equivalent to the combination of A and B. So they should be priced similarly. And there are a lot of applications, like the financial crisis. They just break the mortgage into components, into principal and interest. So you have interest, you have a principal, combined you have the mortgage. And then they sell the principal component, the interest component separately to different investors. Some investors prefer to have the safer, to be safe. They would buy the principal component, and some prefer higher return. They will buy interest component, and of course you have prepayment risks and etc. So that's another application. Arbitrage. So if the price of C deviates substantially from the combination of A and B, we could arbitrage. We could make a profit. Just like in case you don't arbitrage, at least you would choose a better option, like the whole life, term life example I gave you. So it will influence your decision making. And let's look at this one. This I don't know if you can see this or not. This one talk about a bond pricing example. So essentially, let's look at this. Buy the bond today, $940. In 1 year, you are going to get $1,000. So this is a zero coupon bond, no interest, no coupon. Okay. And if you borrow from the bank $952 and you pay $1,000 to the bank in 1 year, okay? So essentially, you take a loan of $1,000 from a bank, and the bank give you $952 today. You owe them $1,000 later. And you turn around, use this $952 to buy the bond, invest in the bond. In one bond, $940. That promise you $1,000 in 1 year. Then in 1 year, you could sell the bond and pay back the bank loan. So you are even. But if you look at today, you have a net positive cash flow. You have a profit. And as more and more people are doing this arbitrage, the bond price will go higher and higher, eventually reach $952.38. and you can no longer profit from this mispricing. So the bond price in equivalent by law of one price would be 952.938. Of course, here the assumption is the risks of these two is the same. But you could find bonds, investment grade bonds, for example, bonds from Walmart or FedEx. They are very unlikely to go bankrupt, right? So you could essentially do the arbitrage. So that's in the finance world. But you have to have a lot of money and leverage to do this, to make a huge profit. But even in today's world, so we have to be a little relevant. Today is the Amazon Prime Day, right? You could theoretically buy something cheap yesterday and today from Amazon and resell later on at a higher price. That's called arbitrage as well. Okay, I don't know how many of you do that, but I did place some orders, for the Amazon Prime Day. I didn't spend a lot, but I did participate because I want to, keep in touch with latest events, so I can make my lectures more relevant. Have you bought anything from Amazon Prime Days?
I have not. No.
No deals?
I'm not either.
Yeah, this year not many good deals. So not nearly as good as Black Fridays. But anyway, I think there are professionals. I mean, professional sellers. They just buying. They know the prices. They buy on the deal day and then sell on eBay, on other places. Okay, make a profit. I used to have friends do that, and now they started working for those big companies and have no time for that. And they form their own businesses, some of them very profitable. So you can see this example, you have arbitrage opportunities, right? And in real life, you do have that opportunity too. And I'll give you another example. So I own a rental apartment. Multi-family apartments. The interest rate is 4.25%. And recently I bought a car. It's really hard to buy a car nowadays. Okay, so the car parking lots are empty. So I bought one and took out a loan. They asked me whether pay cash or take a loan. I have cash to buy the car, but then okay, why don't you do financing, or why don't you help? So they give me a quote to start with 5.1%. I said, well, I saw you have the 2.99%, 3.99% for the 5 year, 2.99 for 3 years. Can you do better? Actually you can bargain with financing personnel there. So I said, you got to be able to do better. He said, oh, let me look. So he looked and said, well, 4.8%, that's the best I can do. So, well, 4.8% is much higher. I think it's, I want to see, a little lower, and can you do better? So he went out, took a cup of coffee, and came back and looked up further. He said, well, the best I can do is 4%. So from 5.1 to 4%. I said, my budget is 3.5% lower. Then I think I have more incentives to do it, to do the financing. If they did a one financing deal, they make a commission, right? So they want to do a deal with me. So instead of me paying cash, then they don't profit from it. So I just happened to tell them 3.5%. I should have stated lower. And the guy dig deeper and locked interest rate of 3.49%, and from Wells Fargo. Now, so with that 3.49%, I freed up my cash. I could use the cash to pay my mortgage for the rental, right? So that's kind of an arbitrage as well. So depending on which loan is more, it's cheaper, then I could apply the cash to a more expensive one. But of course, you have to calculate the tax implications, etc. So there are a lot of arbitrage or financial decisions you could apply the materials we covered today. Now let's look at a forward contract. Let's look at a forward contract or futures contract on a single share of a stock. Consider we are buying a Microsoft stock, a share, for $100. Okay, hypothetical. Okay, assume the current price is $98. So $98 current. Okay. Current price $98, $97, and in 1 year, that's $400. Okay. That's an obligation to buy. You must buy in a forward contract. You got to fulfill your obligations. Whereas in options, you don't. We'll look at options too. Okay. First, let's look at a forward contract. Suppose there's no dividends whatsoever. And the question is, how much are you willing to buy or sell this 1 year $100 obligation? We know Microsoft may go up or go down, right? So how much are you willing to pay for this forward contract? It got to have a value today, right? How much? So in order to value this forward contract, we need to build out a portfolio that pay out the same, have exactly the same patterns. So how do we do that? So in 1 year, let's think about it in 1 year, okay? In 1 year. So this forward contract, okay? Forward contract. So this is time 0 to 1 year. I don't know how much, but this is $100 for 1 share, okay? 1 share, Microsoft. So essentially, you own 1 share after paying that $100, okay? So how are we going to replicate this? So we have a cash outflow of 100, have an inflow of 1 share, right? So that's a pattern, cash flow pattern. Can we do something like that? So if we can somehow get this $100, this 1 share there, and then we could build a portfolio somehow to replicate that. That would be the best. Okay. So what if I, buy 1 share of the stock right now, and I'm going to have that share, okay, later on. And if I borrow this bond, it's kind of borrowing $92. So I invested $92. So I invested this much, and later I'm going to receive $100, right? If I invest this much this bond. And if I somehow get this $97, pay this $97, I'm going to get one share of the stock, right? One share. Okay. And I could sell this later on. Or I could do this, let's see, how do I reverse this pattern? This is $100, one share, and 92, 97. So these numbers are all there. And let's see. If I short sell a bond, I'm going to receive $92, and I have to pay 100 in the future, right? And if I short sell let's say a stock, let's see, how do I make this one? 92, 97, right? So if I got to have one share of stock, okay, so pay $100, get a share of stock, and that price is 97, and this is a negative 92, and here the difference is $5. So if this is a combination of portfolio of a bond and a share portfolio, that perfectly track the future cash flows, then we could make an argument that the forward contract will be valued at this price. So that's a basic idea of building a tracking portfolio. So somehow replicate the cash flow patterns. So at time zero, we buy one share and sell short this zero coupon. And in 1 year, our share price will be this much, and we'll have this obligation. And the value and this pattern cash flow is exactly the same as this forward contract pattern. So that's a $5 cost. So you might think, okay, there's something wrong with the signs. So let me make it more consistent. So if you short sell, you have a cash inflow of $92. If you buy a share, you have a cash outflow of $97. So this is a negative $95. So that means you are spending $5. So here, if you buy that make that a forward contract, the cost is $5. Cost is $5. It's a outflow. Okay. So that's a fair value of that forward contract. If you are going to buy it. Initially, the forward contract is zero. Okay, it's zero cost. But as time move on, okay, the forward contract will have value. So here we are talking about somewhere in the middle. Okay. So that's one way to replicate a forward contract. So the key here is to identify the cash flow patterns and replicate that cash flow patterns, just like the initial example of whole life insurance I talked about. And with that, then you can backtrack to time zero and find out the value of the two tracking portfolios. They track each other, replicate each other. Then the price should be similar, should be the same by law of one price. So we start with the end in mind and ending cash flows and see if we can replicate those. And if we can, then how do we replicate it? So here's another example about derivatives pricing. Essentially, we try to find out the forward exchange rate. Okay, so I'll leave this example to you because I on the slide it explained everything. But I'd cover the options pricing. Options pricing is a little more complex relative to forward contracts, but I'll show you how to do that. Okay. And the forward futures valuation, the one we just did, is called a cash and carry. So let's talk about options valuation. We'll use a similar methodology. You see, we have the Black-Scholes option pricing model, but we could get very close to the Black-Scholes model results with this simple idea of tracking portfolios. And it's much more intuitive, and it is much more useful in financial engineering. Here, the option pricing depends on volatility, like how volatile. The more volatile, the higher the options value, because the more likely you are going to hit your target. And the difference between the asset price, current price, and the strike price, whether in the money or out of the money, and the interest rate, and the time to expiration. So these are the important factors, and these factors variables are in the option pricing models, and we use those in the modeling or replicating portfolio as well. Let's look at this one. Suppose the current price of a stock is $50. So currently, the stock, let me use red, I think. Red color is better. So S0 is $50. So up is $55 in 1 year. Or if it's down, you go to $45. Okay, these are like the volatility measures. Okay, it fluctuates. And the strike price is $51, expiring at the end of the period. And assume the interest rate is 5%. What's the value of a call option? So what's the value of a call option? Value of the call option is equal to how much? So suppose one call equal to one share, okay? But when you are trading, you know, it's one call equal to 100. That's a multiplier, 100 shares. But as long as you understand this concept, it could be any multiplier. Okay, so we just use 1-to-1 ratio at this moment. So we suppose we bought this call option at a cost C0. When it's up, what's our profit? When it's up, we have a profit, right? Our profit is 55 minus 51, right? Equal to $4. So we'll make a $4 profit. When it's
Gross
done,
profit,
our
right?
profit is 0 because when the stock price is below the strike price, we just let it expire. We don't have obligation to buy the stock because we could buy the stock at $45 instead of $51. But if the stock price goes up at $55, we could still pay $51, buy the stock, and sell at $55, make a $4 profit. So for that call option, when the stock price is up, we make $4. When it's down, our payoff is 0. Yes, there's a question, right?
Yeah, I was just going to question that because don't we have to take out whatever the premium is? So when it's down, it's not going to be 0. We're actually going to be negative because of whatever premium we paid for that option.
Yeah, so whatever you paid, that's in time 0, right? You paid already. So we are trying to calculate what this premium is. Okay.
Okay.
Are you willing to pay $1 for this? 50 cents? 20 cents? $2? $3? The maximum you pay is $4, right? Because the maximum you are going to make is $4, right?
Mm-hmm.
So how can we do this? So what's the value of this call option? Can we build something to replicate these cash flows? To find out the call C0. So that's a challenge.
So in valuing an option, you're calculating what the premium should be based off your expectation?
Correct. We are trying to calculate the premium or call price C0.
And then you would just compare that to whatever they're offering and see if it's better or worse?
You could do that, but in the market, it's going to be very similar. To be honest, it's going to be very similar at any point in time. It depends on the volatility and things, a lot of other variables. But what we are trying to find out is what's the fair value for the call option. It's going to be worth something. It's not 0, right? Because you have the option, right? And the maximum is 4. I know it's somewhere between 0 and 4, but I don't know exactly how much. You could do an auction, auction it off. See, whoever pays the highest gets this option. You could be the bidder to bid for this option. So you would be a fool if you pay $4 for that, right? So you wouldn't want you have some reservation price. Okay. So what should it be? So we want to make a cash flow pattern of $4 when it's up, and when it's down, it's 0. So I would do something like this, okay? Suppose I buy N shares, okay? Suppose I buy N shares, okay? N shares, okay? And at $50 now, right? So what's the value of this in 1 year? So it's n times S1, right? Whatever its price is, just put it in, okay? If I borrow B dollars, if I borrow B, and in the future, this becomes B multiplied by at 5%, 1.05%, right? So if it's up, okay, so if it's up, what's our portfolio return? Portfolio value? It's 55N. The price is 55, right? 55N plus B times 1.05. It's not percent, 5%. 1 plus 5% is 1.05, okay? So 1.05B. When it's up, the portfolio value is this much, right? Do you agree?
Yes.
So when it's downward, what's our portfolio value?
Same thing, but instead of 55, put 45.
45N. But the bond is safe. It's going to be that, right? That's the portfolio value, right?
Yes.
And now is a critical moment, okay? The magic moment. If I say I make this equal to 4, I make this equal to 0, then our portfolio replicate this exactly, right? Exactly. When it's up, it's 4. When it's down, it's 0. Right? So our portfolio value, this should equal to this C0, right? Because it's the same, right? When it's up, it's 4. When it's down, it's 0. Right? Replicating each other, right? Now, we have 2 equations. This is equation 1. This is equation 2. And the 2 unknowns, N and B. And we could find out what is N, what is B. And once we find out N and B, we can plug into this equation to find out the core value. Let's do that, okay? So we have equation 1, 55N plus 1.05B equal to 4. Equation 2, 45N plus 1.05B equal to 0. If we use 1 minus 2, what do we get? We get a 10N equal to 4, right? You see, if you use 1 minus 2, this becomes 10N. This canceled out. This 4 minus 0 is 4. So N is equal to 0.4, right? And we plug N into any of this equation. Solve for B equal to, just plug into this equation, for example. So 45, so it's 45 times 0.4 plus 1.05B equal to 0. So what is B? B equal to negative, right? Because borrowing. 45 times 0.4 over 1.05. What is this number? You get a calculator?
Professor, how did you know to subtract the two equations?
Because you have two unknowns, two equations, right? You can solve for two variables, two unknowns with two equations, right?
Yeah.
And the way I'm subtracting these two is because I know these two will cancel out, okay? When I subtract, I just took a shortcut there. And in reality, anything it is like this, okay? And I know you definitely know how to solve two unknowns, x and y, from two equations, right?
Yeah. It's been a long time since I've had to do that, so I'm rusty, but I didn't remember ever subtracting like that. What we always did is, so in equation 1, let's say we solve for n. So we would say, let's move 1.05b to the other side. So you'd have 4 minus 1.05b equals 55n. You divide by 55. So now you have n equals that. And then what you do is you'd plug that n value into the second equation to isolate a variable and solve for it.
Yeah, that works too. So you could do it this way, okay? So you move the 55n to the other side. So it's 1.05b equal to 4 minus 55n, right? You could do that, right? And then you replace this 1.05b here with this value. You could do it. There are multiple ways you can do it. Okay, but eventually you'll be able to solve for n and b, and this b equal to 17.14. So 17.14. And plug into this equation. Okay, plug into this equation. So essentially we have 0.4 times 50 minus 17.14. So what is this value? $2.86. And this is 2.86. Because these portfolios replicate each other, you see, here, I would argue this call option is equal to $2.86. You see, we just build a replicate portfolio and replicate each other. And by law of one price, we argue that the call price, the fair call price should be $2.86. And I have a tutorial. I have a PDF document I'll share with you to go through the process. Okay.
Yeah.
But
so
the concepts, you should understand. Try to understand. Okay.
You lost me there for just 1 second. So how did you get the 2.86? I followed you all the way to where you solved for b.
I just
using your
plugged
method.
in n to this equation, 0.4 times 50. I plug in this b, it's a negative 17.14. Plug into this equation, so that answer is 2.86.
And that's your n value?
No, that's a portfolio value. N shares plus this b. Okay.
Okay.
See, this is 20, right? N times 50 is 20. Minus b is 17.14. So the difference is 2.86.
So you calculated your n is 0.4?
Correct. So that's right there. And b is right here, negative. Okay. And that negative sign will go here. Okay, go to a negative sign. Okay. So 20 minus 17.14 is 2.86. Got it?
Yes.
So
Okay,
this
thank
is
you.
you're welcome. So that's exactly what we did. And of course, on this slide, it gives a lot of symbols, but the intuition is the same. So up state, the call value is $4. Down state, it's 0. And we are trying to replicate this with a share, n share, pi share of stock, and a sum of this bond. Okay. And this is a risk neutral approach. And we have this replicating approach. So that's exactly what I went through. So you build a portfolio of stock and bonds to replicate the call option. And theoretically, you can do that. But with time, you have to rebalance. That's called a delta gamma of the call options. You have to rebalance the stock and bonds portfolio because things will change over time. You cannot have a static portfolio. You got to be dynamic. Okay. But in the pricing wise, at any point in time, we could do this replication. And when we solve for that, it's $2.86. Okay. Because we have two unknown variables in two equations. And of course, there are other approaches to the option valuation. And in this case, we call this 0.4 shares. We call it a delta. Okay, delta. So we could have a hedged portfolio, so that the key is to maintain the two portfolios at the same value at any point in time, so they replicate each other, and then we can use the law of one price to price the securities. And similarly, you can price currency options. You can price, do money market hedging, and etc. I'll share with you the slides of these slides, and also I'm going to share with you this binomial option pricing for stocks and currencies. I wrote up, years ago, but the method, like addition, subtraction, haven't changed for I don't know how many years. Still 1 + 2 is 3, right? Those are called principles. And this option pricing model, this binomial option pricing model, will last for whatever number of years, just like 1 + 2 is 3, until the point 1 + 2 is no longer 3, then this won't apply. But in the foreseeable future, this is a fundamental finance principle will apply. And I'll give to you this tutorial and go through this a little bit detail to help you understand the option pricing for stocks and currencies. Okay. But I think I've covered everything. I gave you my personal examples, a few, and also went through a forward contract pricing similar to futures, and also that forward contract you have the obligation, and then we went through a flexible one. You have no obligation, which is what we call options. So we went through that pricing model as well. And on the slides, I have a few more examples. You can study at your own pace. So I just went through, I think, everything I plan to cover in this 1 hour time frame. And if you have questions, I'll be happy to answer your questions.
I have one question regarding options and profit potential.
Okay.
So somewhere in the book, it shows a graph that is like the profit potential for a call and then the profit potential for a put. And the way the profit potential works is it's a flat line below a certain, up until your strike price. And then if the actual price gets it, it goes straight up. So you have unlimited profit potential. And then on the call, it's the inverse, where the lower it gets, you have an unlimited potential, and then it drops down to a flat loss at this value below the strike price, right?
Correct.
Let's see. I could find the exact page
yeah,
so we can look at the
I'll
same
show
thing.
you. Okay. So suppose you bought this call price at $2.86, right? So you spend this much, right? So the maximum you lose is negative $2.86, right? That's the maximum of your loss, right?
Mm-hmm.
And this strike price is $51. Okay, so at maturity, so this is at a maturity, or expiration date. So if it's $51, if the stock price is equal to, what is your payoff? You get 0, right? Because you buy at 51, sell at 51. So you have a loss. You have a loss over that. If stock price is $40, you are not going to exercise your option. So
and that's where you're just at the negative line.
You lose that. Okay, so it's this line, right?
Mm-hmm.
So when the stock price rises above $51, you start to exercise your option and have a profit. So let's say, suppose it's 53. So what's your profit from the exercising option? $2, right?
Mm-hmm.
But you still have a loss, right?
86 cents loss,
so the point is right there. So it goes to there. So this crossover point is 53.86.
So I understand that.
And then your unlimited upside potential, if it goes to like $1,000, you are going to make 1,000 minus 51. That's your profit minus 2.86. So your profit will go very, very high. So this is the payoff chart of this call option, and you can similarly do a put option payoff chart.
Yeah, and that's what I was at that point with understanding. And what I was saying, if you wanted to, couldn't you buy one call and one put at the same strike price and get a V shape, where if it goes to either extreme, you'd be making a profit? You just have a deeper premium dip. Say I bought a put with a strike price of 51 for a $2.86 premium. I would go down to negative 586 at my lowest point.
That is what we call a put call parity. Okay, put call parity. And by that put call parity, you are not going to make a profit from it. Okay.
Couldn't you make a profit though? If the price moves in an extreme in one direction or the other?
No, you can't make a profit because it's dictated by that parity relation. And now, the way you are making a profit is because you have a loss section, you have a profit section. Okay, so the probabilities overall, your expected value is 0. So although it's just like you go into a casino, spin that wheel, or toss that coin, the expected probability is 50% on tail or head. But when you actually throwing that, the result could be just a head, you win. Okay, but over the long run, it's like a win and loss. Okay. So with that, it's cancel out each other. So your net earnings is still 0. But doesn't mean you cannot make a profit for sure. Because if your gamble is correct, you make a profit. Otherwise, you had a loss. But if you do that consistently, or you have a group of traders, one on the one side, the other on the other side, right? So you have winners and losers. It's zero sum. Oh, otherwise, where does the money come from, right?
Well, here's what I'm saying. It may not be zero sum. So the whole point of an option is there's a limited loss with an infinite upside potential. I mean, it's not realistic that it's going to go to infinity, but if you buy an option and you're below your strike price, you're just not going to exercise it, and you're stuck with whatever the premium is. It's a limited loss.
Okay, let's do that put. Okay, you can do that put. Okay.
Mm-hmm.
So you could do that put option. So the put option chart is something like this, right? When the stock price decline, you have a gain. Otherwise, you have a loss. Okay, suppose it's something like this. So what's when you overlap these two? When you overlap these two, what do we get? Right? So when we overlap these two, we probably get something like this. We probably get something like this. So you kind of get a V-shaped. But in the middle, if the price doesn't fluctuate, then you lose, right?
Exactly. But if it does fluctuate outside that, you could you could buy one put, one call, and you could still make a profit with a limited loss.
Yeah, people do this all the time. Okay, it's called a straddle. This is so basically, if you are expecting extreme moves, you could use combinations of put calls to profit from either big up or big down swings.
Okay. Yeah, that's exactly what I was just asking about, if that was a thing. Or
yeah, you could do that, but how likely is that, right? And in reality, I tried to do that, but it is very hard to do because
I'm guessing
volatility is a variable in put call pricing. If you are expecting big moves, the market is expecting that, and that makes the call prices very high, and this price very high. You are going to, something like this.
Yeah.
Would you do it? No.
No, I'm not saying I would do that strategy in practice, but in theory, you could do it. And
yes, and people do it all the time. I tell you, it's a common practice. It's not like people not doing that. Traders do this all the time. Okay, so it's I think you are learning this. I think I feel very happy for you because you really learn a lot of stuff there. And you could do something like this too. Okay, so not only profit from that, if you think you could do something like this, going up. You could have any patterns. If you watched my video on the risk management with derivatives, I discussed you could make any shape with financial engineering. You have a combination of securities. Then you can have all kinds of payoff patterns. If you ask someone at Goldman Sachs, they'll help you out for sure. Okay, what do you want? They can tailor it, and we call it financial engineering. Very good question. I like your comment. Yeah, that's all I have for this session, and I hope you learn something, enjoy the discussions, and I hope you have a good evening.
Thank you, Professor. I still had that question after.
Okay. Okay. Yeah, we'll disconnect and do another one. Okay. Okay. Any more questions about this portfolio replication or the law of one price? If not, I will just conclude here, okay? And if any of you have questions, please just send me an email in the next few minutes, and I'll set up a Zoom meeting with you, okay?
Thank you, Professor.
Sure, thank you.
Would you like me to send you that email, Professor, or do you already know that?
Definitely. Send me an email or send me a Zoom link. I'll be able to join, okay?
Okay, I'll just send you a Zoom link.
Okay, I'll talk to
Thank
you in a
you.
moment.
Have a good night.
Sure, you have a good night too.